please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to this special broadcast of the macroeconomic numbers that are expected any time now. We've already got the February CPI number at 4.4%. This is better than Ekta's poll, which threw up 4.77, but it was always expected to be better because even as we were taking the poll, and Ekta will bear me out, there were a lot of people saying that the vegetable prices had surprised on the downside, and therefore you are more likely to get a number that is, lower than what the poll threw up. My guess is that it will be the food inflation that will come in lower, but we're just waiting for more details. This is a very good number, and it is likely to give the bond market a bigger fillip. It was to some extent factored in, you will have to say. Even today, the bond markets have closed at 7.63, which is the lowest yield since mid-February. It's almost a one-month low. And that's the IIP number, excellent number, coming in at 7.5. I mean, I think that's even better than the 7.1 that we got for the month of December.
And
so
that's
this
much
is
better than our poll of 6.6%. Lata. But for CPI, I just wanted to point out that the lowest estimate we got was 4.5%. So it's even lower than the lowest estimate.
No, I got even a 4.36 yesterday when I did a dipstick because people were revising their numbers after
lower.
putting out their official number. And therefore, this was kind of factored that it will come below the 4.5 mark. Now, the food inflation number is what I'm looking for. February combined food inflation number has come in at 3.26. So now that's substantially lower than I think the 4.7. Food inflation was 4.7 in January, coming down to 3.26. So quite clearly an indication that prices have, especially of vegetables, have fallen rather sharply. In fact, I can give you all those numbers. Cereals are down to just a 2% rise in prices year on year. Meat and fish, 3%. Eggs, of course, is expensive at 8%. Milk and milk products, 3.8%. Oils and fats, 1%, 1.09%. Fruits, 4.8%. Vegetables, 17.57%. But, you're comparing year on year. If you compare month on month, it's been a fairly decent performance of vegetables. Actually, I could even give you that. Vegetables have remained, have actually fallen from an index number of 151 to 140. So month on month, from Jan to Feb, you've actually seen a fall in vegetable prices. It still shows 17% only because of the year ago effect, which is the demon effect when vegetable prices crashed. Sugars, again, minus 0.26. Then let's get to food and beverages as a whole is just 3.38%. So that's a fairly benign food inflation number. Clothing, 5.12 up. Footwear up 4.14. Housing is up 8.28. That is, of course, the 7th Pay Commission house rent, which gets worked into this. And fuel and light, 6.8. Miscellaneous is just a mere 3.85. So I think even the core inflation will come in lower than the 5.14 that we got last month. But I'll wait for the experts to tell me that. For the moment, household goods and services is 4%, 4.1 actually. Health is 4.95, so that's almost 5%. But transport and communication, 2.39. Recreation and amusement, 4.25. Educational services, 4%. And personal care and effects, 4.24%. Overall miscellaneous, which actually represents services, is up 3.85%. My sense is therefore core inflation will come in lower. Still waiting for the IIP numbers. We just have the headline number. You've got more?
Just pulling up the press release, Lata. So we have the IIP. Just give me a minute because I'm just going to get the press.
Yes, it's just taking its time to refresh. Okay, quick estimates of the index industrial output.
Maybe we can get a comment.
No, I think we've got the numbers. I'll just read out since we have to just give our experts the data. You have the IIP number coming in at 7.5%. And the April-Jan number now coming in at 4.1%. Then you have electricity coming in at 7.6%, very good number. I think manufacturing is just runaway, 8.7%. And if I remember right, even last month was a very good number, 8.5 or something like that. So, we've got 2 consecutive years. Okay, it was 8. Electricity
0.7% figure last time.
That's a very good number. And mining, of course, has done quite badly at 0.1%. So it's a very good number that's coming in even on the industrial output front. I'll just try and give you that consumer durable and those other important numbers which we normally look at. Capital goods is at 14.6. Again, a very good number coming in. See, you must remember that the base is bad in many of these cases. Consumer durables often does badly. Consumer durables actually looks like it's done well this time. It's 8% consumer durables, and consumer non-durables I'm unable to read from this press release. So we'll look for consumer non-durables when our team flashes it. But overall, you will have to say that this is a double dose of good news. Inflation lower than expected, growth higher than expected. You can't ask for more when the stock market is in a mood to discount good news.
So consumer durables, Lata, has come in at 8% growth, and non-durables is at 10.5% growth.
Non-durables, of course, has been charging up at double digits. Last month was 16.5, the month before was 23. So, I mean, this obviously is a base effect as well. But
doesn't this data point to a bit of a blue sky scenario, low inflation, high growth?
Well, yes, but it's 1 month. I mean, I guess inflation will be a little subdued, considering that food inflation has continued to remain, food prices have continued to remain under pressure. But we will have to see about growth and get our experts in. DK Joshi, Soumyakanti Ghosh of SBI and Tushar Arora of HDFC Bank are all with us. First, your thoughts, Soumya. What's core inflation basically? Miscellaneous came in at 3.38. So is this core inflation lower than the month of January?
I think core is almost static. Core is at 5.17%. So in December it was 5.13. January it is 5.14. So it's almost static for the last 3 months. And I think that is also explained by the core inflation, which has also dropped. So that's the one first good news. The second good news is that the inflation number is actually 20 basis points lower than the market consensus. I think the market was around 4.6%.
Yes.
So that means that the 5.1 to 5.6% target for the first half, and also the 4.5 to 4.6% target for the second half, are likely to be breached on the downside. So that's the CPI trajectory, and the vegetable prices have crashed by around 8% in the first 10 days of March. So the journey of lower prices will continue in the month of March also. And IIP, I believe that the best is yet to come. I think the February could be the best month for IIP, given that February was the lowest, is the best in terms of the base effect. So if I include all these news, I think these are the very good set of numbers which we have got today.
What's your next inflation number, March end?
March, I think the way it is, March should be lower than this number, and I can see, Lata, that there are some numbers now consistently should be below the 4%. I think October number, December numbers, possibly one of the numbers, even if we, will be recessively below the 4% mark, and even if we assuming that there could be some impact of the MSP hike, I think that will still take the number to below 4%. So as of now, as of today, if the trends continue like this, there is a possibility of these projections by the central bank of being breached by around 30 to 40 basis points on the downside.
Well, similar question to you, Mr. Joshi. What is your estimate? This 4.4, what was your estimate, and how do you see the future trajectory of inflation?
Well, I think our estimate was a little higher than the market. We were expecting 4.8, 4.9. I think the vegetable prices have surprised on the downside, and one should remember that these are seasonal movements. So I think vegetable inflation can also move up, and also I think if the government tries to implement the MSP policy, and they are effective in doing that, then I think that will create some pressure on food inflation as well, because imports will get costlier and the domestic the prices will rise a little bit. But having said that, I think still our forecast for 2018-19 stands at 4.6%, which is actually very much in the comfort zone of the central bank.
Okay. Tushar Arora of HDFC Bank is with us as well. Tushar, what's your reading of the CPI data as well as IIP?
I think Lata has put out very well. I think it's a double dose of good news, and I think markets should be cheering this fact tomorrow when they open after a spectacular run today as well. On the CPI, we were a bit higher than the market estimates, and I think on the IIP front also we have been pleasantly surprised. And I think we generally focus ourselves on the CPI debate, but I think for past 2 to 3 months, IIP has been surprisingly doing very well. And I think the good news is it is not only getting broad-based, it is also gaining some robust traction going ahead. And I think manufacturing, if the pace continues like this, I think we should experience a V-shaped recovery from the lows of GST and demonetization. I think earlier markets were anticipating somewhat a U-shaped recovery from such lows, but now I think things are pretty well. Having said that, I think we should not be very optimistic at this stage. There are 2 points of caution which I would like to point out. On the CPI front, I think last quarter is seasonally weak in terms of food prices. Food prices generally come down in the last quarter of any financial year. So I think the good news would only be if this kind of trend lasts, maybe going into the next quarter as well. When we see more clarity on MSP hikes, when we see more clarity on pay commission awards implemented by the state governments, and on the second thing, on the IIP front, I think I think the understanding is that the urban side of the economy is doing well, but there are some jitteriness, some points of worry on the rural side. And if the rural side remains weak, then I don't think manufacturing can continue to grow like this for a very long time. So I think the rural side has to catch up on the IIP side, and food inflation has to continue to go down going into the next quarter as well for this kind of good news to last long.
Yeah. I wanted to know, whether this will influence any of your growth numbers. But we are also joined by Upasana Bharadwaj, the senior economist from Kotak Bank. Upasana, your reaction first to the 7.5% growth number, industrial growth number. Now the overall growth for the year comes to 4.1%. That is April-Jan. Would you want to revise any of your GDP numbers higher?
Yeah, fantastic numbers, I think, both IIP and CPI. For IIP, we were looking at a 6.8%, and clearly this is a huge surprise. And the surprise is largely on the manufacturing side. So definitely, I think we are witnessing the pent-up, depressed demand which is there earlier. Probably the impact of that is now getting visible more and more as we go forward, as the impact of, demonetization and GST gradually start fading off. So we do expect the subsequent quarters to be far better. But having said that, for FY18, we would still like to stick around 6.4% of GVA and probably see a much more significant improvement in the subsequent quarters into FY19.
Okay. Soumya, can you reiterate what did you said in terms of your average inflation in the first half of FY19 and second half of 19? How does that compare with what the RBI has so far forecast?
See, the RBI projection for the first half, if I am correct, is 5.1 to 5.6%.
Yes.
And the second quarter is around 4.5 to 4.6%. As of today, we are just juxtaposing the trend growth rate. And it seems that even if we take the outlier impact, for example, the MSP into account, and if we assume that it adds around, say, some 20 basis points to the headline inflation number, so that will still make the average inflation in the first half around 30 basis points lower than the RBI projections. So my sense is that as of, and I am, and given the way the trajectory is looking like, I am sure that there will be some negative surprises, mostly in the second half of this year, where the sum of the numbers could actually hit sub 4%. Even if I take these MSP factors into account. So taking all these factors into account, my sense is that it will be well within the RBI projections of this 4 to 6% band. I think it should be mostly in the 4 to 5% band throughout the most of FY19. There could be some 1 or 2 negative surprises, possibly in the month of May, but keeping aside that, I think most of the numbers as of now should look reasonable and within the RBI target.
What is the March forecast? I forget. March 2018, next month's forecast of RBI?
RBI, I think March forecast, I think earlier it was, I don't remember the number, but I think it will be lower than the RBI forecast.
Okay, so you're expecting it would be even lower than 4.4?
Yes.
Okay.
It will be even lower because you are expecting a 4.6% and the vegetable prices have actually declined by 7% in the first 10 days.
Okay.
Mr. D.K. Joshi, I just wanted to come to you with regards to what you think probably the RBI stance would be, because the view was that maybe there would be room to probably hike rates. But do you think that that argument would probably stand rested simply because of what we are seeing with the food inflation trajectory?
Well, clearly, I think we didn't expect them to hurry, to be in a hurry to raise rates. And I think what we were factoring in for the entire 2018-19 year was 25 basis point hike at best. So I think at least I don't see the rate hike happening in the first half. I think if given these surprises, and I think if inflation stays in the broad trajectory which they have forecast, and actually now the chances are that it could be slightly lower than that, I don't see them in a hurry to raise rates. And also I think we should not forget that the oil prices have been reasonably benign, I would say, from what was expected earlier. So particularly for the Indian basket, as a consequence, I think the shock from the oil is not that much, as was expected earlier. So I don't see the RBI changing its stance. I think they will still maintain caution in their language, and I think the stance that we saw in the February policy will, I see the same continuing in the April policy as well.
But Tushar, isn't there a big case for yields to come down even further? Will they, say, starting tomorrow?
I think they already come down a bit from 7.7, 7.8% levels, and there has been some value buying in the last couple of days. But I think the scope for further dip is limited because markets, some participants have already started pricing in a rate hike scenario, maybe in the first half or second half. We are not in the camp of first half, but a lot of participants are looking for a rate hike in the first half of this year. So I think that dip would be very limited and would be for a very shallow period of time. On RBI, I think our sense is that there could be a rate hike maybe in the last quarter of FY19, and the central bank could fall behind the curve this time, because I think they would tend to ignore maybe some negative set of readings that could come around May, June. I think I completely agree with Mr. Joshi that they would not be in a hurry to hike rates, and this could be another reason as to what can come as a bit of a relief for the markets in the short term. There could be some value buying, but in the second half, as I said, there are a lot of risk, and I think a lot of people are not discounting the fact that demand is coming back, as the IIP story is telling you, and if demand comes back in a very robust fashion, then I think core inflation goes up in the second half. Whether MSP goes up or not, whether there is other factors or not, but the demand pressures would come back.
Okay, that's yeah, I guess RBI has to be cognizant of that, and it has been. Upasana, case for foreign yields, you think? Upasana, can you hear me? I think we will have to redial.
Yeah, hello. Yeah.
I'm just asking you if you expect yields to fall further. If yes, by how much? Because of this number.
Just a couple of things here. Of course, there is a downward surprise to the CPI numbers, and the bond markets will react positively for sure tomorrow. But having said that, I think what we need to really keep in mind is the demand-supply dynamics. There is one big player which has yet not been coming into the market, and that has been skewing the bond markets. There was a distortion because of that. And unless, those aspects are not addressed by the policymakers, probably we will still not see a significant rally. And along with that, of course, we've talked about several risks, be it the NSP, the state seventh pay commission implementation, even the custom duty hikes, which could probably impose some 15 to 20 basis of an impact on CPI. So I think all in all, there are risks. maybe more skewed to the second half of the year. But having said that, it is the first half which will be seeing almost 65% of the supply coming. And if the public sector banks do not really come full on, then there could still be pressure on the bond market.
Okay. Well, I guess you want an OMO, Upasana?
No, definitely not. I'm not looking at an OMO purchase yet because liquidity situation is expected to ease out as we enter, the end of April or May. But I think there are several other demands by the banks, some of it which has to be addressed. Or probably the policymakers will have to find a mid-path where they can address some of the issues and see how they can really go ahead with those.
Okay. Well, actually, I'm wondering if we can very quickly take a poll as to if any of you are expecting a rate hike in 2018, if any of you have changed your views. Tushar, rate hike in 2018?
Well, in FY19, last quarter, 1.
Okay. Mr. Joshi?
25 basis point on in the second half.
Second half, okay. Soumya?
No, I am not expecting a rate hike. In fact, a prolonged pause.
Okay. And Upasana?
Yeah, Lata, even I would be biased for a prolonged pause.
Okay. Well, if I can very quickly just ask you all if any of you are changing your growth numbers or giving an upward bias to it. Are you, Upasana, after looking at this good IIP number?
No, still sticking to 6.4% as GVA for this year, and next year 7.1%.
Okay. Mr. Joshi?
Yeah, we already have a robust forecast of 7.5% for next year. We are sticking to that.
Okay. Soumya?
No, we are not changing our forecast. And just one point, Lata, you are asking about the Q4 RBI number. That is 5.1%, which is given in the February policy. So, and now the average looks like it should be in the range of 4.6 to 4.7%.
Okay, a good half.
So that means a 40 basis point undershooting as of today.
So wouldn't an undershooting give an option for maybe a rate cut?
I doubt that. They are in neutral terrain. But yeah, you never know. Soumya, anyway, are you changing your growth numbers at all?
No, I am not changing my growth numbers. Ours was at 6.6% for the full year for this year, and we will stick to that as of now. So next year we're at 7.3%.
And Tushar, you are at? Will you change?
We're exactly in line with Soumya. I think we are also not changing our call. 6.6 for this year and 7.3 for next year.
All right. Gentlemen and Upasana, thank you very much for participating in this discussion. The economy has got a double dose of good news. Inflation has come in lower than expected, and it's likely that the March inflation will be around current levels, maybe 4.5, 4.6, in which case it undershoots the Reserve Bank's forecast by over 0.5 percentage points or over 50 basis. And more importantly, growth as well coming in, industrial growth as well coming in at 7.5%, much higher than what the street was expecting. But there's some breaking news before we wind up.
Yes, absolutely. There is some breaking news where Tata Sons, we do understand, is likely to sell stake in TCS, and I think it's 1.48% stake. So that would be something that we need to watch out for. It would be a block deal which will be done, and 1.48%, raising $1.2 billion. But that's all the time that we have on the show. Thanks, guys, for watching. Up next, all the news and views you need.